My name is Robert Bishop. I'm a partner at Goodwin Procter in our technology emerging companies practice, and I'm also co-chair of our FinTech practice. Excited to be part of this event as a sponsor and a participant. These are incredibly exciting times in terms of the dynamics in the FinTech market. On the one hand, you have an immense amount of funding being poured into FinTech companies. I saw a recent Accenture report that indicated that $12 billion were funded into FinTech companies worldwide in 2014. That's 300% growth in just 2 years. And what's most interesting about that was that 40% of those investment transactions were focused at the very front end of the funnel. We're talking about Series A and Series Seed financings. And that suggests that there's a real robust pipeline of emerging technologies and companies that are growing up through the ranks and getting funding. On the other end of the spectrum, you have large multi-technology conglomerates moving into FinTech. And a classic example is Apple and Apple Pay. And sort of sandwiched in between these two market forces are the legacy of financial institutions who are increasingly embracing technology for fear of being disrupted in their own marketplaces and losing market share to these market forces. So much so that they're not only sponsoring incubators, but in some instances actually setting up incubators themselves and investing directly in FinTech startups. As an overlay to this, you have heavily regulated regimes that are increasingly changing as regulators strive to keep up with the pace of FinTech innovation and try to adopt or adapt to new technologies in FinTech that don't fit within the existing regimes. And included in this is an enhanced focus on data privacy and security, which are obviously hot buttons in technology generally, but particularly in the FinTech space. And as an aside, that's sort of our sweet spot at Goodwin Procter in terms of being able to contribute to the community. We not only have a nationally ranked technology practice, but we have a nationally ranked financial services practice, and with deep expertise across a number of subsections within FinTech. But in the midst of all these market dynamics and changes, we're increasingly seeing, on a worldwide basis, community-minded organizations being set up for the sole purposes of fostering FinTech innovation. And these institutions are really or organizations are really the bedrock of the FinTech landscape, because they bring together thought leaders and community and industry participants with the focus of improving the FinTech ecosystems that they operate in. And we need to look no further than our own backyard for two examples. One is the FinTech Sandbox, and I know Gene, the executive director, who's also a sponsor, will be touching on this afternoon and talking about the great work that they're doing in terms of providing data licenses to participants in their program and building a robust environment of mentorship for FinTech companies. And of course, we have the MIT FinTech Club here and the great work that the organizers are doing in terms of building a robust ecosystem around FinTech, not only on this campus, but for Boston more generally, and obviously their efforts in putting together this conference today. I had the good fortune last night to attend the speakers reception. I learned two interesting things about the MIT FinTech Club. The first is that it's apparently the second of its kind in the country in terms of being a student-run and led community focused on FinTech. And the second is that this conference is actually the first in the country of its nature in terms of being a community-led, FinTech-focused, student-led conference focused exclusively on FinTech. And initially that was a surprise to me. I thought, how can that be? We've got so much innovation and so much activity in FinTech. When I took a step back and thought about it, I realized, it actually makes perfect sense. When you think about the DNA of MIT, it's only natural that the organizers here would be pioneers in this area. So with that, I'd like to say hats off and congratulations and thank you to Chris, Carlos, Melton, Dan, and the rest of your colleagues. Thank you for your initiative, your passion, and most importantly, your community-centric view. We at Goodwin are thrilled to be a sponsor and look forward to being a long-term partner with you. And with that, I'll turn it over to the first speaker, who's Sam from Betterment. Sam Swift has a PhD from Carnegie Mellon, I believe, and he's a data scientist at Betterment, well-known robo-advisor. So, Sam?
Thanks so much, and thanks everybody for being here for the 8:30 early start. This is the crowd, the subset of everyone that'll be here in the afternoon. This is the crowd that really cares about it, right? So thanks very much for having me and for including Betterment in the list of inspiring and exciting companies working in this space. If you aren't that familiar with Betterment, I should owe you a little bit of an introduction. At Betterment, we try to be the right answer for almost anyone asking the question, what should I be doing with my money? There are a lot of people with a lot of money out there who don't have a confident answer to that right now. So when you come to Betterment with basically any of the money that you're not keeping in your checking account month to month, we'll set you up on a investing and savings plan oriented around goals. So whether it's your safety net, your retirement, build wealth, or people have a lot of more specific goals. We have people saving for houses and for education. We have people with goals for motorcycles and boob jobs, and it doesn't matter what your goals are. We give you a tool and an environment to define those goals, get the right advice on how to invest for them, and then to work towards reaching them. We were founded in 2008. That's our CEO and founder, John Stein. He came out of an MBA at Columbia, went into finance, started making some money, and then was stuck in this mid-20s situation where you're supposed to be investing, you're excited about it, and you don't have a lot of the right guidance. One of his first investments was this red-hot energy company that he heard about, and it went really well for a while, and then the name of the company was Enron. And so that was one of his formative experiences, was trying to invest sort of on his own and finding out that there's a lot more to that than really everybody should be wading into on their own necessarily. So in 2010, 5 years ago, we're just about to have our 5-year anniversary as a publicly available product. We launched it at TechCrunch Disrupt in New York. And in the last 5 years, we've stayed in New York. We're now in the Flatiron. We've got 2 floors of a nice historic building, and we're up to about 100 employees now. I just checked on our careers page, and we have 17 openings currently, and I get a free vacation if I find somebody to fill one of them. So I would love for anyone here that's looking to work in this space to come let me know. So one of the things that makes us exciting and that I really like about Betterment, and one of the reasons I joined, is that we have a business model that's not just different from sort of legacy financial services, but it's actually fairly differentiated from other people that are in the space right now. So one of our main differentiators is how vertically integrated we are. So vertical integration is something that we think of highly of lots of our most impressive companies, right? Apple controls the software, the hardware, and the retail, and that way they can do everything the way they want it. Carnegie Steel controlled the mines, the rails, and the mills, right? They owned that whole process and could deliver more impressive or have more influence over the experience as a result. At Betterment, we do the advising, the portfolio management, and the broker-dealer trading layers. And that's actually fairly unique in this space. So to get a little bit technical, because I think this audience is into that kind of thing, we have an omnibus structure. So we go through a trading firm called Apex, like a lot of the people in the space do. But we actually have one big account called Betterment at Apex. And all of our customer accounts are handled on our side. And so what that lets us do is manage that whole process. When someone signs up, we can have them trading currently next morning. So if you sign up at 11 p.m. at Betterment, we have you in the market the next morning. We're working towards a feature that will actually accelerate that pretty close to instant, that will have you in the market as soon as you're in the sign-up flow. It lets us do a lot of things from a business model perspective because that keeps our costs really low. So if you have to go through a third party to manage all of that, there are fixed costs on each customer, right? And that limits your scalability, and it limits the number of customers and the types of customers that you can have. Our fixed cost for adding new customers is in the $1 or $2 range. A lot of people similar in the space who aren't handling the whole stack like we are paying $30 to $50 to onboard new customers. And that changes a lot what sort of acquisition you can do and what sort of services you can offer. We're also able to do a lot of exciting things now, and we're set up to do a lot of really crazy things in the future. But because we are handling this whole stack, we can do fractional shares. So we have no minimum investment. If you come in with $10 to start, we'll invest you in our entire diversified global portfolio, right? We have tax loss harvesting, which is a really popular feature. And we can implement that for accounts of any size now, because we're dealing down to 9 decimal places. So when one of your tickers drops, we can sell you out of it internally. So when I say internally, we do a lot of trade netting. So because all of our customers are in one big omnibus account, we net trades before we go to market, keeping the bid-ask spread out of the question for most of our customers' needs, and reducing our market transaction costs. It's also really easy for us to set up as many goals as you need, because we manage those different accounts. If you want an IRA now, and you have a traditional now, and then you realize that we're advising you to get a Roth, you can just set that up and it's done, right? It's as simple as working through our interface. There's no additional legal complexity or friction out in the world. And then finally, the other differentiating element of our business that's sort of fundamental is our transparent fee structure. So we have a assets under management advisory fee, and that's it. So any of our customers and any of the investors or industry wonks can calculate pretty accurately from our publicly announced assets under management what our revenue is. There's no other story or complexity to that. So we charge on average around 25 basis points across our entire assets under management, and that's the end of the story. We don't get any commissions. We don't own any of the underlying ETFs, so we're not working on those fees. We don't sell trade flow or anything like that. So it's really simple, and it's really clear both to us and to our customers what we're doing and why we do it. And we like that objectivity because we're essentially offering advice, and everyone should know exactly what our incentives are in that. And our incentives are just for all of our customers to have more money in the future than they have now. And that's generally what our customers are looking for as well. Another aspect of our business is that we're excited to be one of the best tools for implementing sort of a passive, well-diversified investment strategy. But we're not just a tool, right? So if people are calling us robo-advisors, and if we want to be in the advisory space, you can't just give people the right tools to implement a passive trading strategy. You need to help them with advice. And so our goal-based approach is the first layer of that, where we say, what are you trying to accomplish? How long is it until you retire? How long is it before you want to buy that house? And that's what we've been doing for a few years now. Just yesterday, actually, this is timely news, we launched a brand new feature called Retire Guide. And Retire Guide is a pretty comprehensive retirement planning feature. And it sort of takes us into some coverage yesterday said that the algorithmic crowd is moving into the advice. So we're using an algorithm not to implement trades or to design your portfolio, but to tell you how much you need to be saving and in which ways. So this takes into account how much you have saved already, outside investments, your retirement age, your spouse's retirement age, how much Social Security you want to assume that you might get in the future, and gives you advice on your annual current spending rates as recommended, with a sort of best case or likely outcome and conservative outcome, so that people can sort of plan around their own comfort level there. And what we're working towards is a world where people get a little bit closer back to the feeling that people had in the 50s and 60s with defined benefits, right? So we want people to be able to live their financial lives knowing that their retirement is pretty much taken care of, that they have some certainty around how that's going to play out that feels a lot different than being an individual investor without that sort of planning and structure. So with those features and that sort of model around our business, we've been growing fairly quickly. So as I said, we're approaching our 5-year anniversary. In December, we hit a big milestone. We hit $1 billion assets under management and 50,000 customers. We actually hit both of those milestones like within 2 days of each other, which is an exciting time. But things are growing even more quickly now. So in the last 4 months, we've doubled that assets under management, and now we have 84,000 customers, making us by far the largest robo-advisor, automated investment manager by number of customers, and awfully close in the race on assets. We have a hard time keeping this graphic up to date because we always keep hitting fun milestones, and our designers are like, I do have other work to do. You know, I can't just keep adding more vertical to this. So when we think about what we're doing next, how we're evaluating how to spend our resources as a company innovating and extending our feature set, we think about optimizing returns net of fees, taxes, and behavior. So I think each of those pieces is familiar to everybody here and is part of a lot of discussions in the fintech space and in the finance space generally. But I don't think that most firms are paying so much attention to that whole equation, right? So a lot of people spend a lot of their time maximizing portfolio returns. And that's obviously the top of the equation, and it has a big effect on this bottom number, which is what we really care about. But it's not the whole story. So we also work a lot on that. Our investment team is constantly evaluating how effective our diversified portfolio of low-cost ETFs is. But we aren't trying to predict the markets. We aren't trying to, get into or out of Europe because I heard that it's going to be the thing or not going to be the thing. We're trying to build the most robust, most efficient basket of ETFs to sort of maximize that risk-reward, risk-return ratio in expectation. And then after that, we're working on each of these things that tends to detract from that top-line number in a lot of people's investment lives. So fees is largely on us, right? It's not that's our job to be as efficient as we can internally and to pass that savings on to our clients. So we have our lowest fee tier is 15 basis points. That goes on top of the average of the underlying fees in the ETFs. So most people are out the door, all included, in around the 25 basis points range. So that's about as low as you can get for a strategy that isn't DIY at Vanguard in a few low-cost funds yourself. And then we hope to offer a lot more for that money. Taxes is a huge piece of the equation, one that a lot of individual investors know is important, but because it's so hard to calculate, is hard to pay enough attention to. People have the intention of doing things in a tax-efficient manner and have some concept of offsetting gains with losses or harvesting losses. But a lot of those strategies and a lot of those ideas require so much tabulation and monitoring that it's hard to implement. So we do a lot of tax loss harvesting and what we call tax-min lot management. So I guess I'll hit tax loss harvesting just in case that's not familiar to everybody. The idea there being that you can bank losses by selling an asset that has decreased in value and use those losses to offset gains when it's time to pay taxes. The reason you wouldn't want to just always do that is because you have a stable investment strategy and you're not trying to time the market. So you're not trying to sell out of things every time they go down. The clever part about tax loss harvesting is that we're investing you in a bunch of ETFs, most of which have many options. So if you invest in a S&P ETF, there are lots of S&P ETFs. So when the S&P dips, we can sell you out of our primary S&P ETF and buy you into an identical one, right? That way your investment strategy and your exposure remains constant. And since we don't have any transaction fees, there's no friction on that. And now you have the same investment strategy with some losses banked for offsetting future gains. And so that's a strategy that's been done for high net worth investors for a long time. Now we're able to offer it to everyone. Traditionally, it was like end of year. Well, that's right, how people would talk about it. It's December 30th, and everyone's selling their losses. We do this on an ongoing basis. We're constantly monitoring every ticker on every account, and we can sell you out of things when it's optimal, when our algorithm suggests that it's worth the hassle, basically. And then finally, behavior. There's so much research on people underperforming, in reality, the potential returns of their investment or of their investment strategy. And so that's a little bit of a softer topic, but that's actually my specialty and my focus. So I came out of the research on judgment and decision-making world, out of academia. And so this is my spot here where I want to make sure that our customers reach their full potential in their investments. So to go through sort of a case study in that behavioral topic, getting more into the things that I actually work on, imagine we don't give people that much to do in their investment accounts. You can't trade individual stocks. You can't, we don't set it up to sort of speculate, so that we limit the number of ways that you can go off track. But here's a tool that we give people that has some potential for misuse. So allocation changes. You have in each of your goals an allocation between stocks and bonds, and you can change that whenever you want. There are no transaction costs. It trades immediately, and we make it as tax efficient as possible by keeping track of the tax lots in each account. And that's totally appropriate when you realize that it's going to be 5 more years until you need to buy that house you're saving for. You should have more exposure to stocks in that 5 years than if it's coming up very soon. What if, though, people aren't using the allocation change tool for their underlying financial needs that have changed? They're using it to respond to the market. And we know that most people aren't really good at responding to the market, right? So what this shows is the blue line is the market return. So this is the third and fourth quarter of last year. So this is the market return. This is the market going up. And what do we see? The average allocation change is towards stocks during that period. And the market dips down, and now the average allocation change is towards bonds. We shouldn't see this correlation if these changes are just about people's underlying financial needs changing, right? Those should be idiosyncratic. The fact that we do see this correlation means that we've got room to improve on helping people not be market responsive and be fundamental in their planning. I should note that this is the average of all the allocation changes that were made during that week. And we actually see only about 5 out of every 1,000 users making changes during each of these periods. So the vast majority of our users are doing great and being very much buy and hold investors. But we want to help everybody we can, and we track. And we came out with an article recently tracking how much this is costing some of our customers. This graph shows the number of allocation changes that the users made in their account, and the behavior gap of that group of users. So among people who have made 2 allocation changes, they're averaging 40 bips below what their portfolio would have returned if they'd just left it, right? So this shows that this large bucket of people who haven't made any changes are getting exactly what their portfolio is designed to get, what it had the potential to get this year. On average, people who change their allocation more, who are potentially trying to time the market, maybe they can't help themselves or maybe they think they're doing great, are actually underperforming what we've given them. So we're trying to work on that. One thing we can do is take advantage of people's natural aversion to taxes. So people hate taxes a lot, and they'll sometimes avoid them sort of disproportionately to the cost they're looking at incurring. We recently unveiled this feature called Tax Impact Preview, which shows you before you make a change, either an allocation change or withdrawal, what your estimated taxes are on that based on which tax lots we have to sell and how all that's going to play out. This is a feature we don't think that anyone else offers, seeing in prospect what the tax implications of a given action are, because most places don't have the ability to calculate it. It's actually really tricky. So this user was about to make a change, and they see that it's going to cost them up to $5.88 in taxes at the end of the year. And you think, well, that doesn't sound like a very big deal, right? This person probably has $50,000 or $100,000 in their account. What we see is that even very small amounts change people's behavior very significantly. So these are people who got no estimate. And they looked at an allocation change, and 37% of people decided to go through with it. These are people who chose to see that information, and they saw that they weren't going to incur any taxes. Interesting that already dropped to 31%. That just might be like a more inquisitive, more hedging crowd. This is the bucket that I really like the most. These are people to whom we said, this is going to cost you somewhere in the neighborhood of cents. The average tax impact in this bucket was 17 cents. And it dropped from 31% to 24%. People are saying, whoa, 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 I'm not paying taxes to do this. I was just messing around. And it drops, so this is sort of a log scale right here, $1 to $5, $5 to $50, more than $50. And up here, this might be an actual financial decision. You're not going to make this decision if it costs you, $150 in taxes. Maybe that's not worth it. But up here we're in the psychological territory, right? And that's okay. What we're trying to do is design a system that understands people's psychology, realizes that behavior is a real part of the system, and designs something that leads them to their success. And our final piece is this new feature that we're trying to be a little bit less robo and a little bit more advisor by asking why you're doing something. If you walked into your advisor's office and said, I know we just had a planning meeting last quarter, and we're going to be 90% stocks for the next 20 years, but I'd like you to sell all the stocks right now. Right? Your advisor probably wouldn't just go ahead and execute that trade without saying, it's your money? Absolutely, it's your money, do whatever you want. It's my job to implement your wishes on your investment. But just curious, what are you thinking is going on? Why are you motivated to do this all of a sudden? And so we've started asking our customers just very simply what their motivation is for most actions on the site. And so now we have data like this, where of allocation changes recently, this is the breakdown of what people were motivated by. These people who said, my underlying goals have changed, that's great. That's the best time to make an allocation change. You're keeping your investments in line with your needs. These people who were bullish and bearish, it's their money, it's their investments, but that's probably not going to reach, yield the highest returns for them. And so we're going to help customize advice and customize information for people that are in those situations. And it would be rude to tell you how great Betterment is without inviting you all to be a part of it. This betterment.com/MIT link will get everybody 3 months free, which is triple our normal sign-up bonus. So I think I have a couple minutes for questions. And thanks so much for your attention. Yeah.
Nice, Sam. That was terrific. Just give us a sense of 3 years out and 5 years out. Where would the firm be? Not in terms of growth, but what are you trying to do in terms of functionality? Is this phase one of a three-part strategy? Where would the firm be sort of 3 to 5 years out?
So this question is designed to get me in trouble with my CEO for talking about things that I'm the data scientist who doesn't normally do the press tour. We are trying to be, we're trying to give people financial security and peace of mind without the conflict of interest that come with selling them things that they don't need, right? Which is an interesting and sort of narrow target in a lot of ways. In this space of allocating your money across a smart basket of ETFs, we can do that pretty well. And we have the IRA, Roth IRA, and taxable accounts are not the full spectrum of places that people have money. We want to be in all of those places. I'm speaking generally. And we want to be into more of those spaces where people say, I feel like this financial service isn't really, the same way that John identified that he and all of his friends were making bad decisions about their stock investments and that there must be a better way, and this is sort of the evolution of that. We want to solve that problem more generally. I don't think I really answered your question because I don't know which of our plans that I should really talk about. Yeah.
Sam, thanks for the presentation. So this is an industry that's been traditionally dominated by established players like Fidelity and MFS. Now, Fidelity recently endorsed you guys, and I think you guys are working together
right
now. And one of the challenges that these companies have always had is how to tap into millennials and how to get them to save better, save more, which I think is something that your product is very appealing to, especially with the low acquisition cost. Can you comment a little bit on that relationship and how it is sort of work with Fidelity and how do you see that strategic shift for you guys?
Sure. So the Fidelity relationship that he's referring to is we also have an institutional platform where we offer this same software, the same trading structure to investment advisors who want to offer the sort of the human level on top of that. So there are a lot of advisors who especially have particularly high net worth clients and want to serve their friends and family, but it's not financially viable for them to do so. or just advisors who are more, of the mind of this model that, rebalancing someone's portfolio is not something that we need humans to work on these days, and that's not how their time should be spent. So we have a investor institutional platform. Fidelity has partnered with us to offer it to their advisory offices and team. With respect to the millennial crowd, I think we don't sell ourselves as a millennial product. I think our average age right now is about 35, average age of customers, which is not that millennial, right? It's when you look at the whole distribution. I think that we're a great solution for everybody. Obviously, it's an easier sell. Millennials are more of the mind on average that they don't want a guy that they call every quarter. That's not appealing. We don't want to have that phone call. And so, I think the low-touch business model is an easier sell in that crowd, but we want to be the right tool for no matter what stage you're at. So we don't see ourselves as exclusive. We just see that as an easier market.
Can you just grab the microphone?
Yeah, sure.
I just have a really quick question. As you're seeing this user growth, so you're saying it's really exploding lately, are you seeing an increase or a decrease in the size of the average account? I don't know if you can tell or if you know, but I would be curious to see, are you seeing larger investors or smaller investors come around to this idea for a service?
I would say of new customers, we're just seeing a broader spectrum. So we are getting more high net worth clients recently. So in that stat in December, we had 50,000 customers and $1 billion, and now we have 84,000 and $2 billion. So the average account balance has increased significantly. But really, we're seeing, we're moving from the early adopters to the general population, which sort of increases our exposure to both ends of both the net worth scale and the investor experience scale, which is an interesting challenge because the early adopter crowd is easier to serve and more narrow in their needs, and so now we're building out our advice and investing tools for the larger crowd. Yeah. Sorry. Mm-hmm.
So, I'm curious about your acquisition, right, with customers. So, for instance, I feel like this is a product where you have to have some level of, I guess this is a product where you have to have some level of desire to manage your finances. So you have to be a little savvy. How are you going to keep or retain those people who just become really savvy? And feel like they can do this on their own, either by sort of cobbling together, things that are available online through a Vanguard, et cetera. How are you going to keep a lot of those people who you'd appeal to intrinsically because you're offering a little bit of hand-holding but not a lot of high touch?
So the concern being that that it's hard to hold on to the people who are too savvy.
Right. So you have sort of a little bit of an advantage right now, but how are you going to hold on to those people who sort of get really good at this, right? Mm-hmm. Through your product, and then they just sort of say, all right, I can do this on my own, and I can just handle this.
And we're sort of open to that in that we're not our retention strategy isn't to be proprietary, right? Our entire portfolio is on our website. You can implement exactly what we have you invested in on day one yourself without our fee. The trick is costs and efficiency, right? So we really don't charge that much. It's $150 for someone who has $100,000 in an account, right, per year. So if you think about the time and transaction costs it takes to implement what we're offering, that's actually pretty tough to beat. And so I think it works out as a good decision for most people who don't actively enjoy their investing experience. If you really like being on E-Trade and tracking all that and that's an entertainment for you, then we can't compete. But we offer for $150 for that size account, the first time we tax loss harvest, you've come out ahead, right? Because we sold you out of 4 tickers and bought you into 4 tickers, and the transaction costs on all of those would have you're already pretty much there. And so I think it's difficult to actually replicate it DIY unless you really just don't want an advisor, unless you want to be your own investor. Okay, I think I'm out of time. Yeah. Okay. Thanks so much, and I'd love to talk more in the future.